go back to our JPMorgan earnings story because the company reported earnings per share ahead of expectations, $1.28 versus the average estimate on Wall Street of $1.15. Let's bring in Jason Tyler right now. Been speed reading all the numbers. He heads research operations at Ariel Investments, and Ariel manages some $2.4 billion in its namesake fund, which is up 7.5% year to date. Almost 20% for the past year. Jason is in Chicago this morning. Jason, you're a past JPMorgan employee, so I know you know the bank almost better than any other investor on the street. Let's talk about some of the numbers we've seen here and what they say to you. $1.28 versus $1.15. It looks like a clean beat, and revenue coming out ahead of expectations. We know that many investors have been telling us they'd be encouraged if they saw that. Are you?
Yeah, it's first of all, any kind of revenue growth from the company right now is going to be very, very positive, and the investors are going to like it. If you look at what the expectations are over the next even 2 years, Eric, the market's not looking for a lot of earnings or a lot of revenue growth. They're really looking for credit to continue to come down as a big driver for earnings growth.
Okay, now let's talk about specifically the breakdown of net income here, Jason, because the investment bank considerably more profitable than it was in the fourth quarter, thanks to, it would appear, to some strength in trading, but a loss really in retail banking, and cards more or less flat. What does that tell you about JPMorgan? At the very least, we know it's a diversified company, and so it can make up weakness in one area with strength elsewhere, but is that what you wanted to see?
You know, it's funny, it's something that we used to always talk about is first quarter in retail is always going to be a lot weaker than even the market anticipates. It's a shorter number of days. Your net interest income is going to be a little bit lower. Deposits tend to be a little bit less. The flows aren't as good. And people don't really realize that there's even that degree of seasonality in retail. And then back up to the investment bank, I was hoping to see a big number in the investment bank for this quarter. Overall, the market had done really well in first quarter. M&A activity very high. You saw investors moving money a little bit more. So frankly, these were results that were a little bit more in line with the expectations I had.
We were talking just before the break about some of these numbers for JPMorgan Chase. The trading looks particularly strong. Eric and I just going through some of the figures here. For fixed income trading, $5.3 billion. For equity trading, $1.4 billion. This seems like a particularly strong quarter. Can JPMorgan Chase continue this if arguably some of the volatility dies down?
Even if the volatility comes down, I think JPMorgan's picked up market share in this area, which is what we've been talking about for months, that with all the turmoil around the investment banks, who are the clients going to go to as their trader of choice? And it looks like JPMorgan has come out on top. You know, they're the first ones to announce earnings, obviously, as always, and so we'll see how the others do. But this looks like a market share pickup, Deirdre.
A market share pickup, which is to say, Jason, if we look ahead to Goldman Sachs and Morgan Stanley, Bank of America, Citigroup, we might not see a fixed income trading number nearly as high as sort of $5.4, $5.5 billion.
Right, and I think the increase that JPMorgan has, and just in talking to investors and as we do our research on the company, more and more people are seeing JPMorgan as the safe choice, as a place that has the best overall talent, and so we think that that's going to lead to higher market share.
Jason, a curiosity question. How much of these gains do you think are coming from prop trading? Because we know that has to change.
Right. I do think a fair amount of it is coming from that.
Can you give us a percentage?
I think it's hard, at least at this point. But you guys you're picking on the area that I really want to dig into, which is how much of this, even if it is a market share pickup, how much of it is a temporary boost or is a part of a business that's honestly going to have to go away over the next several months.
Jason, I wanted to talk about a few earnings quality issues, if we may. I did some quick back-of-the-envelope math, and it looks like there's a reserve release in the order of $2.5 billion this quarter, bigger than what we saw in the fourth quarter. We've seen these reserve releases, I guess, questioned over the course of the past year as to whether or not JPMorgan is really making the kinds of generating the kinds of sustainable earnings that investors want. Does that raise any red flags for you? Do you think people are going to look at this and over the course of the day say, hey, wait a second, there's just not enough real bottom line here, and maybe the stock doesn't deserve the little uptick it's getting right now?
Yeah, and I think that's why the stock didn't react more positively, is that any time there's going to be a reserve release, people are going to acknowledge that that's not sustainable. But I think it's important for people to realize that this is one of the strongest balance sheets in the country, and we're going to see this type of release over the next couple of years. JPMorgan's balance sheet is just, it's frankly too strong from a reserve perspective. They had $32 billion in provision in 2009, $16 billion in 2010. And if you normalize that number, you get to something more like $7 or $8 billion, or maybe even less. And so we're going to continue to see reserves coming out as credit normalizes.
I wanted to ask you as well, Jason, about the sustainability of the kinds of profits that we're seeing in credit cards. There wasn't a meaningful increase in credit card net income. It rose some $50 or $45 million from the fourth quarter. But I notice here that they've actually reduced the amount of equity in the card business, and so they're generating an ROE in cards of 42%. Is that something you think they can keep up over the course of 2011?
Yeah, in the near term, yes. In the long term, I think it's going to be harder. That business is changing a lot, Eric. And if you think about all the different legislation that's come out over the last couple of years, people focus so much on investment banking, but card is going to have an impact. The marketing dollars are going to have to be spent a lot more intelligently. They're not going to have the ability to get the fee income from a lot of the different reactions they've been able to make over the years. So this business is going to change a lot. 2 or 3 years from now, I don't know if you're going to be able to see that type of ROE.
Is that one of the reasons that maybe they are bringing down the amount of equity in cards, because they don't anticipate that it is going to generate this kind of return over the next several quarters?
That's one. I think more likely is that they're thinking that in the future they're not going to have the credit losses. You know, we saw down to 700 basis points in charge-offs for last quarter and fourth quarter. I don't know I haven't seen what it was this quarter yet. But as that number comes down to 600, eventually it should be 450 or 500 basis points. You just don't need that much equity allocated to that business to sustain those types of lower loss levels.
Jason, it's a bit of a big picture question, but if the Fed begins to tighten, how much of the wind is going to come out of JPMorgan, and not just JPMorgan sales, but other banks as well?
Well, as rates tighten up, there's going to be huge benefits for some of the banking sector. The trust banks just can't wait to have that, and the commercial banks, the true commercial banks dealing with the middle market companies, can't wait for it either, because they're going to be able to raise rates on loans. But for the larger money center banks, it's going to be less of an impact.
Jason, we love having you here on the Inside Track. Jason Tyler, he heads up research operations at Ariel Investments. He was with us from Chicago.